Hello, everyone. This is Paul Roldan, and I'm joined today by a guest speaker, I guess, making her debut, even though she's not new to AllGen at all. Typically, I run these quarterly webinars with my business partner, Jason, but we allowed him to take a vacation this year. So he is actually on vacation as we speak. So we've invited and I'm excited to have Christina Schaefer, who works with Jason in our portfolio management team to speak to us about what we see going on in the economy and markets and some thoughts of what we're doing with our portfolio. So again, welcome to AllGen's quarterly update. Today's July 17th, 2025. And I'm going to take care of a few things first before I hand it off to Christina. First, the agenda. Gonna always try to get you guys engaged. So we'll have a couple of polling questions and do some things there. And then we'll have Christina go and do her thing. And at the end, I'll give you some updates on AllGen, what we see happening on the planning front. And then we'll take some Q&A at the end of it. Now, when I say Q&A, I'm going to tell you how to submit questions. Okay, at the end, you don't have to wait till the end to submit questions, but I'll go over that in the next slide. But as we look to get you engaged, always like to ask a couple of questions. One kind of fun and light, and one a little bit more serious when it comes to the role of finances. So let's go ahead and present the first question, if you will. Survey says, and we're having technology difficulties here. It's not showing up. Okay, here we go. Looking ahead, the 2025 economic landscape. Which of these do you think will affect you most going into the end of the year? Do you think interest rate changes, rising tariffs and trade wars, stock market volatility, or holiday spending? Which of these do you think will affect you the most going into the end of the year? Please, one choice, and we'll give you a few seconds to answer those questions. Not too much thought having to go into this necessarily. All right. That being said, let's see what the poll said. Okay, we've got stock market volatility with a second of interest rate changes, and then the tariffs and holiday spending coming in right around the same. Okay, very good. So thank you for answering that. Let's go to another question. Okay, as far as AI and you, where do you stand as far as AI? There's a lot of talk about how AI is going to take over the world. My son came home from Gainesville last night, and he told me about some article that in the next 6 years, AI will know more than the collective global humanity in 6 years. So, I mean, he said, "I'm scared, Dad." So we'll see. But where do you stand with AI? You can say I'm old school. I picked up the phone and write my own emails. I'm loving it. I use AI tools all the time. I believe in it, but it's honestly overwhelming. Lot to learn. Or I'm cautious, a little worried about where it's all heading for the next generation. All right. And the survey says, loving it, using AI all the time. Oh, no, the big one is I'm cautious. I'm a little worried about where it's all heading. Okay, so we've got those two, the close first and second. Not as many old schoolers and not so many totally convicted, but we got some people loving it. So thank you for answering that. Again, we're gonna get into Christina speaking here, but for as she speaks, feel free to go to the next slide. You can go ahead and type in questions at the bottom there. As you see here at the Q&A. Okay, you can't raise your hand because we probably won't see it, so we've X'd out that option, but just feel free in the Q&A section to type your question as we go. We'll try to make it timely, and we will promise to get to all of them, whether it's on the call or not, depending how long the presentation is and how many questions we get. So without further ado, excited again to introduce my colleague, Christina Schaefer. Please educate us.
Well, thank you. Thank you guys for joining us, and thank you, Paul, for the introduction. So before we get into the death by 1,000 charts, as we nerd out on what's going on in the markets and how we're positioning your portfolios, I want to touch bases on three reoccurring themes that you're going to see in a lot of the price movements, what's going on in the economy, and how we're positioning your portfolios. So one is there's actually yield and fixed income, which should be supportive of returns going forward. The second one is that the economy is slowing. Now, does that mean we're in a recession? No, our answer is no for that for the time being. But the economy is slowing, so we'll dive into what does that mean? What does that mean for what assets we find attractive? And then finally, the one that I think everyone knows, it's kind of related to that volatility that everyone's concerned about, but specifically policy and uncertainty within the US is very high. So it's hard to kind of predict where things are going to go. Things change seemingly overnight. And it just feeds through very heavily into the prices that you'll see in all the different assets and areas of the market that we look at. So without further ado, let's go ahead and dive into what we're looking at across a variety of asset classes. So these are some of the most common areas of the market that we look at and we invest in for you guys. So that's large cap stocks, the S&P 500, small cap stocks, the S&P 600, MSCI ACW XUS. I know that's a mouthful, but that one is international stocks. We have the Bloomberg Aggregate Bond Index, and then we have gold. And so you'll see over on the right, gold is actually one of the best performing areas of the market year to date. It's up 27%. And so what's supporting that? That's really, once again, that third theme coming to play with high policy uncertainty, and as well the dollar dropping. Likewise, international is doing really well year to date, so we'll get into that. This is a really good example of why you want to have diversification in your portfolios and not just own the Mag 7 or the Magnificent 7. But it's up roughly 18% year to date. So we're happy to see that. Happy to see international finally pulling its weight within your portfolios. Bonds have been trucking along roughly at 3% year to date. So we're happy to just not see a pullback after the last 2, 3, 4 years kind of being a little bit carnage, for lack of better terms, in the bond market. We're happy to see a little bit more peaceful experience for you guys there. And then large cap up roughly 7%. And then mid cap stocks or small cap stocks, S&P 600 here in light blue, down roughly 3% year to date. So one thing we want to rewind a little bit back into about April timeframe, looking at sentiment. So a lot of people were very concerned. The market had a pretty big pullback, specifically the S&P 500. And a lot of people were concerned and wondering, should I get out? I don't know if it's going to be rebound. I'm not sure that I'm comfortable with this, right? So this takes a look. I know it's a busy chart. You have the S&P 500 up here in the top, and then down here in orange, you have a short-term sentiment indicator that's actually a composite of many different indicators. So you can see here, it was actually at extreme pessimism, which tends to be a good buying opportunity. So you'll see up in the S&P 500 chart that a lot of times that extreme pessimism precedes a pretty strong rebound within the markets. And then you can even see in the tables down at the bottom that when pessimism is below 41.5, you're looking at anywhere from 23 to 26 on average per year returns. So that's pretty strong. And so what have we seen? We've seen the market bounce back. So even though it was down roughly 15% year to date in the S&P 500, we saw a pretty big rally, over 22% from that bottom up to the top. And now we're roughly 7% year to date. So we don't want to miss out on those returns and that rebound and sell at the bottom and lock in those losses. That's where I know it's a lot easier said than done, but you have to hold on and focus on what you can control, which is your personal finances. You can control your spending, your saving, look at your financial plan with your advisor. And of course, just make sure that you're actually in the correct risk profile and can handle the volatility of the portfolio you're in. Taking a look now that the market has had such a strong rebound, we wanted to touch briefly on valuations. So I think there's starting to be grumblings. You've maybe seen some headlines about, is the market reaching new highs? Is it potentially overvalued now? And so there's a lot of different ways that you can look at valuing the stock market, but here we have one of the most common ones. It's called the forward PE ratio. So that stands for price earnings ratio. And so what you're looking at is essentially relative to how much most companies in the S&P 500 are earning, where are price levels. So the latest value is 22 times earnings. And you can see recently in April, it did pull back and valuations became a little bit more attractive, but it has since become stretched. Now, what does that mean for your portfolio and for our outlook and how we're thinking about stocks? We're not underweight stocks at this time, and we don't generally like to go underweight stocks unless we're very confident that there's going to be a recession, an imminent recession. Otherwise, a lot of times the returns, if you're looking at a diversified portfolio with bonds, stocks, gold, a lot of times stocks really carry a lot of heavy weight in terms of supporting your returns over the long run and allowing that compounding effect to play out over very long periods of time. So it hurts when you essentially go underweight stocks, and then the stock market keeps trucking along. So you have to be we're only really going to go underweight stocks in very specific scenarios and very few and far between. But we're aware valuations are stretched. It's something we're watching. And of course, we're always going to try to find areas of the market that are going to be better deals for you guys. Taking a look and peeling back the layers within the large cap space, you have value stocks and you have growth stocks. So that's here represented by the S&P 500 value and the S&P 500 growth. And the moral of this story here, we'll dig into it a little bit more, but it behooves you to have exposure to both. So you can see here the S&P 500 value in dark blue, and the pullback on around April 8th, it held up much better than growth stocks. So it really benefited investors to be in value versus growth at that point in time. But then you see since then, growth has rallied and now growth is outperforming value year to date. So that's where it's not like an end all be all. It's not black and white where it's like a zero sum game and you only hold one or the other. You want to hold both. And then luckily for you guys, we were value leaning in that pullback earlier in the year. And so that really allowed our portfolios to hold up generally better than the benchmark. And that's us corresponding to implementing our philosophy of managing risk first before anything else. And then over the last month, with that nice rebound in growth, we have added to growth in a lot of the portfolios. Taking a look at small cap stocks or mid cap stocks, you have the S&P 600. And so if you recall back to the very beginning, the first chart we showed, the S&P 600 was down roughly 3% year to date. So what do we want to, what's the key point here? We're actually, relative to what we consider neutral within your portfolio positioning, we're actually slightly underweight mid cap stocks. So we've been able to provide, like dampen the effect and dampen the feed through to your actual returns by being a little bit more overweight large cap stocks and underweight small cap stocks. And what's the reasoning behind that? Why did we see a pullback? I mean, I think we maybe know why we've seen the pullback to 21% earlier in the year with some of the tariff announcements that came into place in April 8th that just rocked the markets. But why are we seeing small cap companies performing poorly year to date? Really the theme here, it circles back to the economy is slowing. So generally when the economy is slowing, small cap stocks are not going to hold up as well. They have a harder time weathering that slowdown. They generally have negative earnings. They're going to have worse profit margins. All of this just is a compilation and puts a little bit more downward pressure. There's more barriers to them, to small cap stocks performing well in a late cycle later on in the economy when things are slowing relative to large cap. But really, one of the best areas is international year to date. So what are we seeing on this front? You can break it down into emerging market stocks, think China, India, or you can look at it from a developed international stock perspective. So think France, Germany, and so forth. So what's interesting is a lot of times you would think kind of the traditional adage is that you got to take on more risk to have better returns within the markets. And emerging market stocks are generally considered riskier than developed international stocks. But as you can see here, year to date, developed international stocks are actually outperforming emerging market stocks. So that's something that just goes to show that it isn't always about just taking on as much risk as you can to get the best returns that you can. Sometimes it pans out, sometimes it doesn't. And really, why is international doing so well? A huge component of that is the dollar. So as you can see, this is a very long-term chart going back to 2007. But what we want to be focused on is over here in 2025. So in 2025, the dollar pulled back almost 10% year to date, which is a pretty sizable move. And so that's really boosted those international returns, as you can see here on the next few charts. So we're looking at focusing on European equities, UK equities, and Japanese equities. That dotted line here in each one of those charts is what those stock markets have returned in their local currencies. Whereas the solid line is what it's returned once it's been converted. Those local currencies have been converted back to US dollars. Those returns have been converted back to US dollars. So you really see here that big boost that the drop in the dollar has provided to international markets and international returns. Removing that drop in the dollar, returns kind of look average. They almost look a little bit like the S&P 500 year to date, right? So it's really that dollar at play and the drop in the dollar that's extremely supportive of international stocks. Taking a step back and looking at international stocks and thinking about a diversified portfolio over a much longer period of time. We wanted to kind of rewind because before this year, we would always receive the question of why are we holding international stocks in our portfolios when the S&P 500 is beating it, and it just seems like it's not necessarily adding any value. So this is a really good example of why. There are time periods where international stocks perform better, and it can be very long time periods. So this is looking at 2001 all the way to 2007. You're looking at an international, you had a cumulative return of 112% versus 32% in the S&P 500. That is a massive difference. And so we want to make sure that we're diversified to capture when this dynamic rolls over. It kind of tends to run in cycles, and it's based off of what's going on in the economy and the global economy. But we don't want to miss out on this opportunity for you guys. So that's why we hold international, and it's been really supportive of portfolio returns year to date. One of the other areas that's probably hit a lot of headlines, and maybe some of you already know this, but gold has done really well year to date. So it's up 27%. And this has really been a lot of supportive fundamentals. So even going into the year and looking at last year, a lot of central banks were buying more gold in their reserves. So that just provided a nice fundamental floor for gold prices. And then as this year progresses, you have a drop in the dollar that's supportive of gold prices. And you also actually have massive flows of investors wanting to invest into gold because of that high policy uncertainty within the US. So there's that theme showing up in price movements within the markets. So all of that is providing a really nice supportive floor for gold and has made gold quite an attractive area of the market to hold year to date. And of course, we hold it in your portfolios. Switching over to bonds. So what are we seeing on the fixed income front? Well, the story is probably similar to maybe what you've heard us say in the past few years, that there's finally yield in fixed income. There's finally yield to be had in bonds. This situation this year is a little bit different, and that the Federal Reserve, though, isn't aggressively hiking rates anymore. If anything, they're cutting rates. They cut rates last year. And then the markets are pricing in maybe 2 rate cuts this year. We'll see how it pans out. But all of that to say, you kind of have a calm background that is underpinning fixed income returns right now. So here you have really high yields. You have a little bit lower volatility within the bond space, the fixed income space. And so that is really supportive of returns. And as you can see here, yields are near almost, I mean, not quite all-time highs, but they're significantly above the 15-year average. So the purple lines within each one of these bars is the 15-year median. And then you have the range within gray, and then you have the blue diamond. That's where the yield currently is. And so you see treasuries, munis, corporate bonds, mortgage-backed securities, all of those have really attractive yields right now. And that generally supports returns going forward. So I know this chart's a little bit busy. Bear with me. We're going to walk through it piece by piece. So what you're seeing here on the x-axis is your starting yield. So where is the yield of a bond at the beginning of a 5-year period? And then on the y-axis, you have your subsequent annualized 5-year return. So what did you get every year over the next 5 years thereafter? And you can see a pretty strong correlation that the higher the starting yield, the better the returns going forward over the next 5 years. Now, there are anomalies to this, and as you probably remember in the early 2020s, which is going to be here in this kind of dark green color, you'll notice those dots are right here where it's below zero in terms of returns. You're having negative returns. And so in that situation, right, we were coming from really low yields, and then the Federal Reserve hiked rates very aggressively. So that's where you're going to see those negative returns. But now where are we? We're at the gray dot right here. where yields are roughly 4.6, and it's applying a forward 5-year annualized return of 4.69%. So that's supportive of bonds going forward, and we find bonds are generally attractive to hold in portfolios. I already touched on this a little bit. The markets are currently pricing in 2 rate cuts for the year, which is really not all that different from what the Federal Reserve is expecting. So here you have FOMC projection, that's referring to the Federal Reserve, and this red dotted line with the squares. And then each year, so the first square is 2026, you have 2025, 2026, and then 2027. And then the light blue line is what markets are actually pricing in as of 7/10. So you can see for 2026, there's really not much of a difference. Markets are pretty aligned with what the Federal Reserve expects, which means that that's kind of contributed to some of this lower volatility that we've seen on the fixed income side in terms of yield movements. And it also means that we don't necessarily see as many opportunities within this space for mispricing, since the markets and the Federal Reserve are pretty closely aligned. Whereas if you've gone back to maybe the start of 2024, there was a massive gap between what the Federal Reserve was projecting and what markets were projecting. And we were actually able to benefit and position your portfolios to benefit from that massive gap and outperformed because of that. But we're just not seeing opportunities within this angle of how we position your portfolio and looking at where yields are going to go, because they're pretty much in line. As for the whole fixed income space, a lot of people I know are more familiar with stocks, but there is a lot under the hood going on within bonds. It can actually get pretty interesting. So you have areas like emerging market bonds, you have high yield corporate bonds, you have mortgage-backed securities that I think everyone knows from 2008. So taking a look under the hood and looking at all the different areas within fixed income, one of the best performing areas year to date has been global bonds. And that goes back to, so that's developed international bonds. And then of course, emerging market bonds have also done well. But that story and why that's happening goes back to the dollar. So a lot of things always go back to the dollar. When the dollar drops, it's really supportive of any international assets. So we're seeing 6.5% returns in global bonds, which we haven't seen in years and many, many years. For a long, long time when yields were very low, even pre-pandemic, and the US was the only game in town, global bonds just really weren't doing anything interesting. It was almost like a boring area of the market. And now this year, because of the drop in the dollar, global bonds really have some life. And then they're also supported by most central banks around the world are actually cutting rates right now. So you have to keep in mind that bond prices and bond yields are kind of like a seesaw, right? So when rates get cut, bond prices go up. So that's why we're seeing, once again, global bonds and emerging market bonds performing so well year to date, even though there's some trade issues going on and potentially a decline in global trade due to the tariffs. You still have the support of central banks cutting. You still have the support of the US dollar falling. So that's the story there. As well, high yield corporates have also performed pretty well. I mean, that's going to be highly correlated with the stock market. So when the stock market's performing well, generally high yield corporates is going to perform well. And you'll even see that as well with investment grade corporates down here. And then you have the US aggregate bond index, is just the broad index we showed in that very first slide that was up a little over 3%. And then one thing I do want to acknowledge is muni bonds are down year to date. So keep in mind, this isn't necessarily showing like yields adjusted for your tax, what tax bracket you actually fall into. So you might not necessarily be experiencing this directly, but it is kind of unheard of for munis to be down when the rest of the market's up. So that's something interesting. We're actually finding that a lot of the fundamentals of munis are still attractive. So it's a great opportunity to be looking at munis, and that's something that we still hold in portfolios for that reason as well, within the taxable portfolios specifically. So switching gears to the economy, I know we're coming up a little bit on time, so I'm going to try to be mindful here. But real GDP is slowing. So as I mentioned, one of the themes for this year is that real GDP is slowing. Now, what does that mean? Like I said, it doesn't mean we're in a recession, but it's something that is flowing through to which assets actually look more attractive. So bonds are going to look more attractive when GDP is slowing. Large cap domestic stocks are going to look more attractive than small cap domestic stocks. So it plays into a lot of what we covered already. But you can see here in this table, it really captures that slowdown. So in one quarter, you're looking at year over year. This is real GDP net of inflation, 3% growth rate year over year. Then it slows down to 2.7, 2.5, and now it's at 2. And trend is typically around 2, 2.1. So it's essentially right at trends, a little bit below trend. But we're not necessarily concerned by this. As you see, post 2008, you had a time period where the economy grew pretty slowly for a very long time, but we weren't necessarily in a recession. Consumers were still spending, were still buying. So the economy was essentially trucking along, which is what our base case is for right now. And so in this chart over here on the right, you can see that consumption accounts for almost 70% of GDP. So that's where the consumer really is so important within the US economy and how much the consumer is able to spend. And so on that note, we always like to look at, can the consumer find a job easily? Is the consumer able to stay in that job for a long period of time? Do they feel like they have job income stability, job security, and so forth? So this is what we're looking at. There's a lot of different charts on here, but we're going to walk through each one. So job openings is over here on the left. And you can see that there was a massive spike in 2022. Some of you might even know or remember or able to recall when it seemed like so many recruiters were just coming and knocking on your door, and companies were offering insane pay for you to switch over and switch companies. And it was just an unprecedented time with the number of job openings, right? Well, since then, we've kind of normalized back to where you could argue a pre-pandemic trend was. So it's not that we're seeing we're seeing any type of anemic conditions within job openings. They're still there. They're just not at the bonker levels, like the crazy off the chart levels in 2022. So it's kind of stabilized back to normal. And then likewise, quits generally is going to follow the same trend. When there's a lot of job openings and companies are offering really good pay bumps, you're going to consider switching potentially, right? So you saw a rise in quits corresponding with that, and it's now pulled back to what you could argue is pre-pandemic trends. So we're not necessarily seeing a lot of people switching jobs as much anymore. And then likewise, what's interesting here is you have layoffs down here on the bottom right. So the 5-year pre-pandemic average for layoffs is roughly 1.8 million. We're actually still below that. My thought process behind this is that companies did struggle so much to try to get employees that they had back in 2022 to find good workers. So I think they're not necessarily wanting to rush to go lay off any of their employees. They'd rather be able to hold on to their good ones and just kind of steady Eddie truck along. So really, the consumer in that regard, the job market for the consumer is still pretty strong, and we're not seeing any signs of massive layoffs coming down the pipeline. And then how does that actually feed to the consumer's finances? So here we're looking at real disposable personal income. So what does that actually mean? That means what's your income, what feeds through to your bottom line of your paycheck after all your taxes are removed. So this is net of taxes. And then real means that inflation, it's also net of inflation. So we're looking at that growth rate in real disposable personal income. And the mean is roughly 3.16% year-over-year growth. So you can see that growth in income has slowed down to roughly 2.07%, but it's not at levels that we see usually in recessions. So what does that mean? I mean, consumers are probably feeling their finances tighten. It definitely depends on which kind of cohort you're a part of, which socioeconomic area you fall within the rungs. Certainly those with a lower socioeconomic status are feeling things tighten even more. But generally speaking, consumers are able to still spend. They still feel comfortable. Their use of credit, there's not massive spikes and flows going on into early delinquencies. I get that looking at this chart, you have student loans, the massive spike up there, but that was more of an anomaly in that we just had deferments and forbearances going on, and that clouded that data for many years, for roughly 4 years. So now it's kind of just bounced back up to what it was pre-pandemic. Is it still high? Yeah, I mean, we're watching it. We're also watching this rise in mortgage rate delinquency. So it's at 3.7%. I'm hoping that that rolls over. That would be the ideal situation, but if it does continue to trend up at that same rate, it could start to become a concern and could potentially impact the housing market. But as of right now, hoping, fingers crossed, it rolls over. And then inflation, I think this is something that is on a lot of people's minds. So you see it when you go to the grocery store, you feel it when you're buying goods. I mean, it's just impacts your daily life. And of course, it's potentially intertwined with tariffs. We'll get into that conversation here in a few slides. But generally, I mean, excluding June, so we just got the June release for CPI on Tuesday of this week. Generally, CPI inflation had actually been coming down. And a lot of that was that shelter component. So, I mean, everyone knows how gangbusters the housing market was and how there were bidding wars and everything. And that really boosted up that shelter component. And it takes a long, long time for that to kind of work its way back down. And so it was working its way back down. You can see that in this dark blue. And it was helping pull down inflation rates. Now, in June, we did see a little bit of a movement back up. What was causing that? It was actually, it seems like shelter within shelter, your owner's equivalent rent or homes are seeming to kind of stabilize, and maybe not, prices aren't falling as much as they were just a year ago. So you're seeing a little bit of a leveling off there, which has been supportive of a little bit higher inflation. You also are seeing technically some shocks within very specific areas of goods based off of the tariffs. So a really good example of that is the baby goods market. The baby goods market back on, I think it was like May 8th or May 5th, in early May, literally all the companies came together and raised prices 25 to 30% all at the same day. So what is that? That's a price shock. And so that's discerning how much of that actually feeds through to inflation, because all those goods, 90% of baby goods comes from China. So that's where that 25 to 30% number is coming from. But when you actually look at the US consumer on aggregate, how much do they actually spend on something niche area of baby goods, right? Like, I don't know that many people actually, it's a very specific time in your life that you're spending on baby goods. And it's generally for, I don't know, 1 to 5 years, right? So that doesn't necessarily feed through to this massive bump up in inflation. What we've really seen is just a tiny inch up. Most of that's driven by shelter, but you are seeing under the surface, there are price shocks happening, but it seems to be in niche areas that people aren't necessarily spending a lot of their paycheck on when it comes like month over month on a regular basis. So now we're to tariffs. I'm sure many of you are waiting to hear about it. Tariffs is kind of the wild card thrown in the mix when it comes to asset allocation and portfolio positioning right now. So that's where we're doing a lot of hedging, and we're holding gold to account for that policy uncertainty, where it seems like there's news every day with tariffs and us negotiating new trade deals. But we also want to keep kind of remove the headlines and talk about the nuance of tariff policy. So you're talking about renegotiating trade deals with every single country. It's not necessarily a blanket across the board. You're going to have a different trade dynamic with China versus with Canada versus with Singapore, right? Every single dynamic is different in terms of what goods are being exchanged and so forth. And so that's where we wanted to take a look at this line of reciprocity. So on the x-axis, you have tariffs imposed by the US, and on the y-axis, you have tariffs, x-axis is tariffs imposed on the US, and then y-axis is tariffs imposed by the US. So generally, if these dots are going to be below the line of reciprocity, that means the other country is actually charging more tariffs than the US. And as you can see, that's generally is what's happening across the board. So like China, there was pretty good grounds for us to renegotiate our trade deal there. It makes a lot of sense. There's also potentially a national security geopolitical component going on there with them wanting to beef up their military and some of the activity going on in the China Sea. So, you know, that's a little bit of a different story. India, it seems like there was opportunities. Brazil, it seems like there was opportunities, but then there's other countries that are maybe being targeted that I'm not so sure that we were that far off from that line of reciprocity and equilibrium. So you have Singapore, you have Mexico, Canada is not too far off either. So that's where it's a really nuanced conversation, and usually the truth is somewhere in the middle, and I don't want to lose sight of that nuance just because of the headlines. And then finally, I mean, we have one more slide for you guys after this, but another point we wanted to touch on is the fact that a lot of the news around tariffs are generally going to be, he uses them as negotiation tactics. So you can see here on April 8th, when that news came and the markets took a dive because they weren't pricing in 30%. They were pricing in some tariffs, but not 30%. You see this massive spike up of what it could have been. And then where is it actually now as of July 4th? It's roughly 15% effective tariff rates. So that's half of what it potentially would have been on April 8th. And so that's where you have to really keep in mind and sort through what's the noise, what's the signal, what's really matters here, what's going to stick and what's not, and what's just a negotiation tactic. As hard as that can be, because some of the headlines can be shocking for some. Digging a little bit further into the tariff dynamic, we wanted to quickly take a look from and think through what could be the logic behind tariffs. So if you're thinking about the balance sheet of the federal government, we of course extended tax cuts with the recent bill, and potentially even increase them with the recent bill. So if you're actually lowering the revenue that the government's receiving in the form of income taxes, you have to make up for that somewhere else, or else deficits are going to continue to widen if you keep spending the same. So essentially, to me, part of the thought process behind this is that, okay, let's lower income taxes, right? But we still need to have revenue. So let's just get revenue another way through tariffs. It may still feed through to the consumer and it may almost kind of net out, but the consumer maybe doesn't feel it as much, because what's going to happen is the company decides how much of that to pass on to the consumer. A lot of times they're probably going to pass on as much as they can to the consumer and keep their profit margins investors happy. But you're kind of doing a little bit of a switcheroo here. And consumers potentially just don't feel it as much when they're paying for goods versus when they're having to actually pay their tax bill in April. And then we've raised a fair bit of revenue. So thus far, year to date, we've raised 99 billion in revenue through tariffs. So we wanted to go ahead and wrap this up. And Paul, I know you're probably itching to get to your section. Hopefully I haven't gone too long. But we just wanted to remind everyone of our investment philosophy. So we want to manage risk first, on the downside, and then try to generally keep up or outperform on the upside. But here you have in the light blue line, 100% upside capture, meaning everything that the S&P 500 does on the upside, you're receiving all of it, you're keeping up with all of it, and it's feeding through, and then 100% on the downside. So taking a look at that versus maybe 95% on the upside, meaning 95% of what the S&P 500 does flows through to returns. And then 90% on the downside, meaning that when the markets pull back, you're actually only pulling back 90% of what the markets are pulling back. So you're potentially outperforming on the downside. You can see that dark blue line. I mean, the difference over very long periods of time can really benefit investors. And seeing in this hypothetical, you have a difference of roughly $480,000. So that's a pretty massive difference. And that's really why it's so important to manage risk on the downside first and foremost. And that's why it's the core tenet of our investment philosophy. So wrapping it all up, what are we seeing? Everything that we've covered here. You of course have your three themes: yield. There's yield to be had in fixed income. Higher bond yields are supportive of 3 to 5% returns over the next few years. I'm sorry, I put 1 year here. It should be 5 years. I'm gonna have to correct that. But we do generally find bonds attractive right now. You also have an economy that's slowing down, so that makes large cap stocks look more attractive than mid cap stocks, small cap stocks. Uncertainty also is very, very high, so that's where you're seeing gold performing really well year to date. We also expect gold to continue to perform well due to that high policy uncertainty and the dollar being weaker year to date. Likewise, we're also seeing international perform really well because of that drop in the dollar. And just keep in mind, policy uncertainty is high. Please expect more volatility. You just don't know. I mean, it's hard to predict. Anything can happen at any time. That's why you want to be in a diversified portfolio, have a financial plan, talk to your advisor about it, make sure you're invested according to what your risk appetite is and risk profile. But Paul, I'll pass it back to you. I'm sure everyone's done hearing me speak.
No, that was wonderful. Thank you, Christina. For those of you listening, I like to just give her a virtual round of applause because that was awesome. I don't think she skipped a beat with Jason not being here. In fact, we'll have to tell Jason his job is on the line. So thank you, Christina. That was also very informative with a lot of questions and uncertainty during this year as we began with a lot of movement happening. So we want to get to some questions that have been asked already. I'm going to just share a few facts about what are going on at Algen and some basic financial planning tips. So while I do that, please feel free to still ask questions in the Q&A section, and we'll ask those in a minute here to Christina. So some additional resources, aside from the quarterly webinars, we have our blog on our website that we contribute stuff literally every month, sometimes weekly, depending on how much time we have to produce the stuff. But it goes everything from Roth IRAs, investments, to tax planning, to education, all kinds of things, health insurance, etc. So feel free. We have them on our blog, and we also have our YouTube channel. So we invite you to monitor our blog, to subscribe to our YouTube channel, because if you subscribe, you'll actually get a notification when we actually post a new video, which again, we try to be very timely on these videos and blogs, so things that are happening, in the economy and the markets, etc. Okay, so we invite you to join us there. Okay, and in addition to that, we want to also I'll give you some dates that are coming up so that we're all aware of these. So for those of you that filed extensions on your taxes, okay, with business taxes are due September 15th, okay, and then personal taxes are due October 15th. So barring any other type of special circumstances, those are your typical deadlines for those extension tax filing. And then we're going back to school. Summer's pretty much over, even though we're still in the middle of July, but I'm already getting emails, for school stuff, coming up. So that usually signifies what we've done in Florida, which is tax-free day or tax-free week. It's been expanded where you can buy school stuff without paying any taxes on it, consumer sales tax. This year, it's been expanded to tax-free month. Okay, here in the state of Florida. So anything you buy starting August 1st through the 31st for schools, and you can go online, Google what those include. You won't have to pay any taxes on. So that might be a little bit of savings for you as we have to spend stuff for stock up for school supplies. Okay. We also want to announce it's that time of year again where we have our Money Sense Camp, which is an event that we put on every year in the summertime. It's basically a summer camp for high schoolers, for teenagers, to teach some financial literacy. And the interesting part about this, that's been one of the biggest issues, in this country, not just among teenagers, but adults. There's been several surveys that talk about the need to improve our financial awareness, which is so interesting with the advent of AI and more information. We still are not getting it. Somehow we're becoming more reluctant on, or more reliant rather, on some of this technology and not absorbing the information ourselves. But that being the case, we will still continue to educate our teenagers to see if they can get an earlier start, and hopefully avoid some of that statement, that cliche statement of, I wish I would have known then what I know now. So we're trying to teach them then while they're still young. The good news is, moving forward, Florida passed legislation that it is a requirement to take some type of financial literacy course to graduate high school. Okay, so that was, I know, advocated heavily by the Financial Planners Association a few years ago, and it finally passed as legislation. So, if not already in your high school, it should be coming to your high school soon, a curriculum that your child will have to go through, just reinforcing a lot of what we do. And what we do is just make sure we equip them with that good information. So that's coming up soon. I think registration might be closed, but please feel free. We have a waiting list, and some people, there's always cancellations. So if you or anyone has a teenager that you think could benefit from this, and people say, "Oh, Dad, Mom, you want me to go to money camp?" And we've seen it day one, and then we see how they light up by day three. Because we keep it active and fun. So that's coming up. And then finally, the One Big Beautiful Bill Act, OBA, or OBA, however you want to pronounce it. How does this affect you? And I'm not going to go into the particulars because it is a big, beautiful bill, if you will. Well, you interpret beautiful, but it is big. But there are some planning opportunities, when it comes to estate planning, when it comes to tax minimization, for individuals as well as for business owners. I know one, and this was an addendum to that. If you live in Florida, they just passed the repeal of the business tax for leases. Okay, so as of October, if you are leasing a commercial property, you may not see, you may be saving 2% every month moving forward on your rent. Okay, so all this to say is we're on top of this. We're looking now to see how we can implement this in our planning process for each individualized situation. So we encourage you to get a hold of your financial advisor to update your plan. You will be receiving, if you're a financial planning client, a request to upload 2024 taxes. Into your financial planning portal so that we can get a head start and see what opportunities there may be for 2025, before you file your taxes for next year. So that will be coming up soon. Here, an email requesting that if you have it, if you've already filed your taxes. If not, we'll just keep on you until you file it by the deadline. So that being the case, also want to give you some information. You guys already know about the path to financial freedom. We encourage you, if you haven't done your plan or if you haven't looked at your plan in a while, let's touch base. It's a great way to clarify priority when there's a lot of uncertainty, a lot of volatility. It's a great time to sit down and say, okay, where am I? What am I trying to accomplish? What are my goals? And how do we make that happen? I always say this, that many years ago, I heard someone say, I cannot control the global economy, but I can control mine. And that's what we focus on a financial plan is how do we put you in charge of your personal economy. So we encourage you to revisit the issue of financial plans planning if you haven't done so in a while, or if you've never done it, we encourage you to just go through the process, and I think you'll find it well worth your time. Okay. And this is just some of the tools that we use for financial planning. I also want to welcome to the team. We've got a couple of new team members. I want you to help me welcome Edward Robinson, as an associate advisor. The guy's a busy guy. He's the father of 5. Okay, so he's a busy man, but he loves helping people on many levels, financially, with spiritual mentoring, growth, as he has some expertise in the area of theology. So a deep guy, but is eager to help you in your financial journey. So we're excited to have him here. So please, as you see him around the office, or shoot him an email, welcoming him to the AllGen team. And in addition to that, we also have Gillen Manos. So Gillen joined us also a couple of months ago. He's a recent graduate of UF. Okay, and he actually already had, I mean, talk about a high achieving, person. Already he passed the CFP exam, so he's a candidate for the CFP designation, and just a sharp, bright young man. So we're excited to have him. He's already contributing all of this value to the team, making sure we're getting things done well and quickly. So when you see him around, please help me welcome him to the team. So without further ado, I know time has been flying here. Please continue to ask questions, but I'm going to now throw some at Christina that people were asking as you were presenting. So I've got Dave who asked a question here. Do you expect to see another tariff negative impact for the upcoming August 1st effective date? And if so, what are you doing to address that?
Yeah.
You get your crystal ball ready.
Yeah. I mean, that's obviously that's notoriously difficult to predict. I try to stick to what I actually can confidently predict, and that's not US policy right now.
Yeah.
That said, there's a couple things that we're doing right now that if that does happen, portfolios should hold up pretty decently. So of course, our investment philosophy is to manage risk first. So what does that look like? We have a diversified portfolio. Even in our most aggressive portfolios, we still hold bonds in order to dampen some of that volatility that you experience from stocks. As I mentioned earlier, we're underweight technically relative to what we'd call our neutral weighting for domestic mid-cap stocks, and overweight large cap stocks. That's also going to dampen a little bit of that volatility that you see in your portfolio. And we hold gold and international stocks as well. But gold should really help too in that situation. And especially if the dollar drops further because of maybe tariffs or confidence within the US.
Yeah, and I think it's important to know that oftentimes the market tries to predict, right, things, and it's forward-looking. So when some announcements were made on July 7th, okay, the market took a drop. Okay, and we saw a drop in anticipation of some of these things happening. So yeah, it's never you know possible to forecast exactly, but as you mentioned, preparing for risk first, managing that no matter what times, and these and not reacting to short-term blips, which is what happened earlier this year. As and even in the pandemic, it was a major issue, and we had a major short-term blip of a high drop in a month, but then it all came back because the state of things were still strong relatively. So we'll see. Stay tuned. Okay. Mark, thank you for your question. Currently, Fed is not aligned with the markets, correct? So I think that was your chart that you put in, which seems actually very close, I thought. But do you see a catch up? So I don't know if you want to reference that chart with the Fed
Yeah, let
versus
me.
what the market is thinking. Thank you for your question, Mark. Yeah, I think you
So
just
it
passed it.
Yeah, so it might just be that you were looking at 2026 and 2027. So specifically for the 2025 year, they're pretty darn aligned. Both are forecasting roughly 2 rate cuts for this year. 2026, there is some discrepancies there. But that is also so far out that there's just going to be more volatility, and the accuracy of the forecast and what's priced in is going to be lower, more volatile the farther out you go. So I'd say they're pretty aligned, which is why we've also seen a little bit of drop in volatility within the fixed income sphere.
Very good. Very good. Um, could the U.S. economy slow down and inflation go higher due to tariffs being passed along to consumers?
Stagflation, is that what we're referring to?
Yeah, it sounds that
Inflation,
way. Yeah.
yeah, inflation rises and GDP declines. That's a really good question. It really, I mean, the answer depends, right? So if you, let's think through different scenarios. I mean, what we're in right now is a little bit more benign than like the worst case scenario. I hate to even use the word benign because many people are feeling it. If you're starting a family right now, you are feeling the fact that baby goods saw a 25 to 30% increase. So of course, everyone's personal economy is always going to be different, and consumption bucket is going to be different. But thinking through that, you could even think in like, what is a worst case scenario? I mean, what if we put, I don't think this is going to happen, knock on wood, but what if 50% tariffs went in across the board? Yeah, that would probably bump up across the board, indiscriminate, applied to every single country. That's going to bump up import prices. Companies are going to try their best to pass it along to consumers as much as they can. And so, yeah, that's gonna flow through to prices for the consumer. Now, the question is that a one-time price shock? If it just happens once, right? It is a one-time price shock. And then what ends up happening is prices just stay at that elevated rate, but the year over year and month over month numbers, right, start to slow back down. That acceleration slows. Now, another kind of worst case scenario is if you saw a gradual ratcheting up over time. So it's like, okay, 20%, 30%, 40%, 50%. And it's slowly over time. Essentially, you're having consecutive price shocks that can actually feed through where it could be higher inflation for a longer period of time. But the devil's in the details. I don't see those two worst case scenarios happening at this time. So I don't know that I'd worry about that. But I mean, it could be a tail risk. It's something, I mean, that's how the mechanics would work.
Yeah, yeah, yeah. No,
Yeah.
those are good points. The multiple intricacies and nuances therein. So, Christina, Dave brought another question to light. You mentioned that the tax cuts, quote unquote, could offset somewhat higher prices due to the tariff tax. But wasn't it just a continuation of the 2017 Trump Tax Act and not an actual reduction of taxes? Maybe I'm misunderstanding, and actually would be great if I'm paying less in taxes going forward as opposed to last year.
Yeah. So there was continuation, but then there were also additional cuts added in, right? So now
That's
we
right.
have higher levels and Paul, correct me if I'm wrong on any of this because it starts to wander into financial planning. But
Yep,
we
yep.
have, I think, higher SALT deductions, right?
That's right.
Which
Yep,
of course maybe doesn't matter for Floridians. But we also have the tip situation where there's no taxes on tips.
correct.
I think also have an additional increase in the childcare credit. There might be one or a few other things I'm forgetting, but yeah, there's some additional actually increases depending on what your specific situation is.
Yeah, and this is where, to add to that, it's really important that we look at your personal situation because, whether it's the child credit, that increased, the personal tax exemption went up. So that was an increase. The whole real estate nuance there, if you own a business taxes are supposed to go down technically. So there's a lot of, you just said devil in the details. It depends on your particular circumstance, whether the taxes are going to be higher in savings, the new tax bill or not, depending on your particular circumstance. So we always encourage you. The intention was definitely there to encourage, even the student loans moving forward, getting some paybacks, waived at certain levels. So we encourage you to come in or chat with your financial planner just to see if there's any details that, and as we do forecasting for your taxes for next year, are there any opportunities with the new bill to really maximize or capitalize in your particular circumstance? And I know we're running out of time here, but another question, I think this is the last one that was sent. For those who are considering or even currently living overseas, should we be concerned about the dollar weakening?
Yeah, that's a good question. I mean, I would almost answer it with a question, but I'll give more and not just leave it at that.
I knew where
Are
you're
you
going. Go ahead.
living, yeah, are you living overseas to try to arbitrage? Are you purposefully living somewhere that has typically a weaker currency than the dollar, and you're purposely trying to arbitrage and take advantage of essentially your dollar is going further, right? So in a situation like that, yeah, you're going to feel more pain when the dollar drops. But let's go back to the dollar slide, wherever it is, real quick. So you can see that there has been roughly a 10% drop year to date, but going back to 2007, 2008, I mean, it's not like the dollar's completely crashing and bottoming out. It's still relative to really long-term trends. It's still elevated. It's still relatively strong. So I think you kind of just gotta get through the short-term pain and some of the volatility there. But yeah, if you're trying to take advantage of your dollars going farther, in the local currency of wherever you're living, it's going to hurt a little bit when the dollar pulls back.
Yeah, again, so many moving parts to this. If you look at that from a technical perspective, it's kind of, yeah, you said long-term trending is touching that resistance, or that support line rather. So according to this, it might even bounce back, to stay above that, so it's not crashing yet. So a lot of nuances as you've seen. This has been an unpredictable year. Oh, the stock market's up. Oh, but it was tanking in the first quarter, or, the beginning of the year. Oh, but wait, small caps actually down this year, but large caps are up. So where do I put my money? So I'm very appreciative for our investment management team. Obviously, I'm biased because I'm a few doors away from them, but I see how hard they work to really keep on top of any breaking news, etc. So if you haven't, I would thank them if I were you, but I thank them personally because I think they do a great job. Guys, this is a lot of information, but Christina, thank you. Always encourage you. We love chatting with you. Please reach out to us, even come in or schedule a virtual meeting so we can answer any questions you may have or update your financial plan. Thank you again for listening, and we look forward to seeing you soon. Have a great day, everyone.